In this video, we're going to talk about 5 ways to make money from trading the news. Stay tuned. Hey traders, a very warm welcome to you. Okay, so I've got 5 ways to trade the news, or 5 different strategies or methods that you could use to trade the news. Currencies, indices, stocks, whatever it may be. Talking about trading here, short-term basis. Right, number 1, a quick data feed and quick news feed. This is pretty much out of the realm that most of us retail traders can trade, but it's one way that potentially companies do make money from trading news. Less so now, because generally, you know, the more money you have, the quicker feed you've got, and it just becomes a game of whoever's got the most money can, you know, get it ahead of everyone else. The whole idea of this being is that you have a really quick data feed of price, you have a really quick data feed for news. If you can see exactly what the news is or the number is before anyone else, assuming the market is open, let's say it's data that comes out while the market is open, you can react quicker than anyone else, and you can place a position, a trade quicker than everyone else. It's not going to happen for you and I, so I wouldn't even potentially try it. Don't even bother getting involved in that. We are way down the totem pole in terms of people who get executed first when it comes to trading in the market. So quick data feed news is out for us, but it's some way that people do make money trading the news. Okay, these are more like our kind of things, guys. Number 2, fading impulse spikes. Very, very often, when news comes out, there will be an impulse move in one direction, an impulse move in the other, and we'll revert back to the mean. Why does that occur? Generally speaking, it occurs because liquidity dries up in the order book and the underlying market. Because people don't want to be picked out or picked off by unusual news coming out that surprises them, an interest rate announcement that wasn't expected, jobless numbers that were way worse than expected or way better than expected, any of those kind of long tail, fat tail events, they don't want to be caught out by them. So liquidity in the order book, and the order book is people having limit orders rested to fill both on the buy side and the sell side, they get completely drained. So you've got very, very, very low liquidity. And so what happens if someone comes in and has a buy order, a market order to buy, a market order to sell, it takes a lot of price levels. And so the price kind of moves up just to fill that relatively small buy order, meaning the actual chart is doing that, as opposed to normal market hours and normal conditions when liquidity is thicker, and the same size order might move price 1 kind of tick or 2 ticks. So it becomes exaggerated. That's why you get these spikes in one direction and the other. So really, there is a strategy, and we've done a video on this, covered this before, where you would look to, the news comes out, you get a spike higher, you get a spike lower, and you kind of revert to the mean. That generally happens a lot more than anything else, depending on the market conditions. When the economy's either improving at the bottom of the cycle, or maybe struggling at the top of the cycle, or same for companies, any kind of thing where there's a wonder or doubt how the news might affect something, this may turn into a trend, and we'll look at that in a second. But generally speaking, when news comes out and it's just a case of it's just going through the motions, they're not expecting anything exciting, this is kind of the sort of pattern you're going to get. And we talked about ways of fading that rather than just kind of try hitting at highs, having a kind of key level that when that breaks, you take a short back to a kind of mean point, or when this breaks. So you've got ways of framing the trade. I'm not going to finite detail with that now, but that's really a thesis and a kind of broad way of approaching it, of saying, hey, I'm going to fade these impulse spikes because there is lack of liquidity. That's why the impulse spikes are there. I'm ready for them. I'm going to assume that it's a mean reversion play, obviously managing risk accordingly and trading that method. The other way, number 3, is to jump on the trend. So whilst, let me get my cloth here, whilst we often have that kind of impulse that takes out highs, takes out lows, and just generally has a little bit of noise, pings a few people out, gets a few people excited, and comes back to where it was. Sometimes we're going to get ways that things that come out that reprice that underlying asset. That could be, whatever it may be, crude oil, the index, the currency pair, whatever. So some sort of news that changes the perceived valuation of that market or instrument more or less than it was just before the news. And so you might get the scenario where you're sitting there before the news, you get a bit of a move up, and your job then as a trader is to jump on that trend. Obviously, there's going to be ways that we look at to kind of decide whether we are fading or jumping on the trend. We've got strategies to do that kind of stuff. But ultimately, if we see there's a potential trend, a surprise news announcement, something that's repricing the market, one way we can make money from that news is to jump on that trend for an extended move. And that could be the start of something multiple days, multiple months even, or it could just be, a nice little day trade depending on how we're doing. All right, so let me rub that one out. Number four, is trading these second tier plays. Now, what's a second tier play? A second tier play is basically the first tier would be the market or instrument that's most impacted by the news or that the news is based on. So, for example, oil inventories. Okay, we have oil inventories come out which kind of say how much oil is in store and all this kind of stuff. Can affect the price of oil. Sometimes it does, sometimes it doesn't. But let's say it comes out and oil then becomes very, very cheap all of a sudden because there's a lot of inventory, perhaps there's a lot more supply coming in, less demand, whatever it may be, the price of oil goes down. That's the primary reaction. But the second tier play is to trade things like the refiners, the oil consumers, anyone that's actually using or producing oil, obviously in the appropriate direction, off the back of that news. So whilst oil is the first tier move, the second tier is going to be companies that are affected quite majorly by that. Same with the currency. If you've got a company that says the dollar is ripping to highs based on some data, you might have a basket of companies that are very susceptible to movements in the US dollar. Maybe they're doing business abroad and they're based in the UK and they've got quite sensitive to the GBP USD rate, whatever it may be. Maybe it's the price of gold. And you've got gold mining companies that are going to make much more money because the price of gold just shoots up based on data, and the second tier plays to play the gold miners. That kind of stuff, you get the idea. It's looking for these second tier plays. And this is well within the realms of a retail trader to trade, because as long as we're prepared and we know what markets and what instruments and stocks and companies are affected by the bigger stuff, then we can go to those knowing that, hey, perhaps these are going to be a bit late to move. Perhaps everyone's going to be piling on this primary market. But if I looked second, even third level plays, I can be there. I can get ready to trade it and be ready to kind of capitalize on the potential move that comes off that. So they're quite nice ones actually. And I've had some good results trading that kind of stuff. Those second tier plays. Number 5 is to capitalize on confusion. What I mean by that, so it's pretty similar to the trend, but we'll just flip it on its head. So in other words, you have this kind of move, pushes up, and then it looks like it's a trend, and then all of a sudden there's confusion. People say it's really good news, really great, but it actually comes all the way down and takes out the level you were at before the good news, in inverted commas. You can capitalize on that. Obviously in this scenario, you'll be looking to go short and then push for a further down move. Now, why do I call it confusion? Is because generally that news is bullish, and this is something a setup we've drilled down into before. But if that news is bullish and it's positive and we have a move up, but then reverses, people are confused. They're like, hey, this was good, it's supposed to be bullish for this market, the news was great, the price has gone up, now it's come down, the price is now trading less than it was before we had the bullish news. I'm confused. Confusion creates opportunity for us as traders, especially if we're trading kind of intraday or short term. Capitalize on that confusion. That's a nice little play to do. All right, guys, there's 1, 2, 3, 4, 5 ways to make money from trading the news. Give it a thumbs up if you like this kind of stuff. Much appreciated. If you haven't subscribed yet, consider doing so round about here, I think it is. And I'll see you in the next video. Take care. Good trading. Keep the risk managed. Goodbye.